This is Brandon Parker. Welcome to another episode of the Legends of Land show, where it's my job to deconstruct world-class land investors, how they think about the business and approach strategy as a land investor. Clint Turner is Learn.Land's founder and CEO, but he's a land investor first. His investment company, now located in Plano, Texas, is going to gross 8 figures in land sales this year. You can find Clint on Twitter at ClintT_land and online at Learn.Land. In this conversation, we cover how you should think about the downturn in the land market, how to manage your cash position, how to find more cash, how to dispo your land quicker in the current markets, and how to grow a multi-million-dollar land business. Without further ado, please enjoy this wide-ranging conversation with Clint Turner.
The Legends of Land show with Brandon Parker. Deconstruct the tactics of world-class land investors and learn tools to build a seven-figure land business. The Legends of Land show is starting now.
All right, Clint Turner, welcome to the show, my friend. How are you doing today?
Doing good, Brandon. Thank you so much for having me.
Yeah, pleasure to have you on the show. So I was been pondering this question lately, but just imagine you are a fairly seasoned land investor. You're at that point where you're doing one deal every month or every 2 months, and you're dealing with cash flow issues, just having trouble getting past that hump of managing cash flow, turning the marketing on and off, and scaling from there. How do you think about that?
If you run a real estate investment business, it's always an issue of your cash is, I don't know where my cash is. I was actually talking with someone on my team 20 minutes before this, and I was like, we need better cash tracking systems for this or this. So, I've been doing this for almost 10 years now, and that issue manifests itself in many different ways. But I think at the beginning when you're bouncing between, I kind of call it the yo-yo of like finding deals, looking for deals, and then actually doing the deals, taking them down, doing whatever, if any business plan that goes along with the deal, and then selling it. There's always lumps. Land is a very lumpy business. I think it depends on a couple of things. One, where you're at, like what your experience level is. So for somebody who's let me say like experience with real estate, that is, if you have, I see a lot of people that have flipped houses or done multifamily or things that they affect get into land, and if they're not somebody that I need to tell, only do one or two deals at a time and really focus on your cash flow. That's something they understand. If you're newer to the business, I've always been a big proponent, and the more I've done deals, I've been a big proponent of staying super focused on the deals and the task at hand. Because it's really easy to like go on Twitter and go on Facebook and go on Instagram and you see a million things going on. And I don't even think it's shiny object syndrome. I think it's just, oh, like I probably should make my sales process better. I should make better marketing. There's always things that can be done in the business. And at the end of the day, like land is a business that revolves around sales and marketing. And so when you take your eye off the ball on doing deals, often that is what I've seen puts people in cash flow situations. So let me give you an example. When I was doing this for a couple years, I started out completely direct mail marketing, right? And at the time, there was like some new shiny objects coming out. Now, I don't think these were like new, but to me, they were new, which was things like subdivides or things like text or bring this voicemail or all these other great ideas that are out there. And if I fast forward a year from when I was like, oh, texting, I can reach a lot of people for less money. And I look back at the results, almost every single time I added a new marketing channel, my net to Clint revenue went down. So when I look back, I'm like, man, I really wish I had stayed focused on what I was good at. One example, I think this is a really cool deal we did. When I started, I was very active in Southern Colorado. And I probably did 200 deals out there, 150, 200 deals, something like that. And like still to this day, I get paid from that portfolio of,
Hmm.
of notes that I built from that. And then the new thing on the block was just not doing deals, little desert square deals like that. And I talked about it. Everyone's talked about it. I look back and I was like, I had such good systems. I had such good marketing. I had such good consistency in that market. And I saw other people just continue to replicate the results I had for a year and a half as I transitioned out of doing those deals. I would have made so much more money if
Hmm.
I really, really focused. Back when I was doing a lot of coaching, I had a client, he always blew my mind. He was very consistent and he worked in 2 counties. And he only added the second county after the first, I think, 3 or 4 years in the business.
Oh, wow.
He consistently made 100,000 the first year, and then made 200,000 the second year, and made 400,000 the third. So I continued to double, just staying singularly focused in one market. And so I see people get very spread out in how they approach the business. And man, if anything, if you're just getting to the point of scaling, it's very important to identify what are you really good at and what is making you money right now, right? Very simple question. What is making you money? And then become more efficient at that thing. So I don't know if that answers your question, but it's very easy to like bounce around. And I think at the end of the day, if you are somebody who's doing one deal a month, 2 deals a month, one deal a quarter, 2 deals a quarter, whatever it is, where are they? What types of deals are they? What size are they? What's the strategy that you're focusing on? And how can you just double and triple down in the same bucket versus like you hear Clint and Brandon talk about somebody's strategy on this podcast, which you'll definitely hear about, and being like, oh, I need to go do that thing because it sounds like it
Mhm.
makes more money. That's why I see a lot of people get lost, and that's how I focus on it.
It's a great take. I've heard Hormozy talk about more, better, new, and it's what you're talking about. If something's working, you're making money on it, keep doing more of that and do more of that until it's completely exhausted. Then do it better and try doing more of it again. It's all that
Mm.
before switching. What do you think the place currently that you might focus on? Do you think that is market dependent or do you think that is entrepreneur dependent? If you were going to say, hey, this is what I would do if I was in year two.
Yeah, I think there's a few things that go into it. Like everybody has different buckets of cash they work from. I think that's something that gets glossed over a ton. Is like, how much money are you working with? How readily accessible is the cash that you're working from? When I started, I was poor. Like I had nothing. I was working with a little bit of extra income from my W-2. I took a loan from my grandpa to take a course, took a loan from my dad to buy the first few properties I did. My access to capital was way different than where it is now. And I've talked to a lot of people that have had different paths and they've come up and they're used to working from 1 million, 2 million, $5 million plus buckets of capital, whether it's their own or relationships with investors. So I think that is often, in my opinion, the driving force because especially in the market right now, in the land market and the land flipping market, one of the, and I think this is going to be very prevalent for 12 to 24 months, one of the most important things is going to be how quickly can you act on deals? Because there's a lot of people out there looking for deals. And when the good deals come up, you need to be able to execute on them. And there is nothing, there is no substitute, there's no fancy talk track, sales script, whatever, that beats like, can you get money in the person's hand fast? This has happened so many times to me. That's why I'm very aware of it. And it's a focus in my business is the efficiency of our capital is I've lost a lot of great deals because I knew they were good deals in theory, but like I didn't have the $1.4 million to buy the property and the 600,000 lined up to do the work I needed to it and all the time and energy to do the project plan, right? I needed 90 days due diligence so that I could go do that. I need 100, you've heard that story before. And I've lost number many like double digit deals, great deals to people who were just positioned to go faster.
Mhm.
People who came in and either they had access to the capital or they were more familiar with the exact market. Like I can look at a market. I do a lot of business in Texas, and there are still markets in Texas where I can't just first glance tell you if it's a great deal. If it's within like 2 hours of Dallas or Austin, I can probably do that with a glance. But Texas is a big state, right? A lot of other areas requires like how efficient can you be? So to answer your question of where should somebody focus, I really think it depends. Like the first thing you think about is how efficient is your capital, right? If your capital is not very efficient, it kind of goes back to like exactly what we were talking about. It makes business sense for you to go do deals that don't make you 10,000 and make you 100,000, right? That's what I'd like to tell somebody to do. That's what I like to tell everybody to do. But can you really just jump to doing those kinds of deals immediately? Like I'm working on a deal right now that I'm gonna have to buy outside of title. And it's gonna cost me like $600,000 in cash. So it's a great deal though. I think we'll make a lot of money on it. Fingers crossed, the deal's not done. But I just use that as an example to say I need to be confident that I can underwrite this title myself. I need to be confident that I understand the property and the exit plan on it. And I need to be confident that I can get the cash to the sellers in time, because this opportunity, it's out there for anybody to find right now. I'm not going to tell you where to look, but it's out there. Or I'm not going to tell you exactly where to look,
Mhm.
but it's out there. Anybody could grab it, and the first person to the doorstep with the check is going to get that deal done. And so if you're really good and confident at closing deals that you buy for 10,000 and sell for 20,000, but you hear Clint, Brandon, and everybody on the internet talking about deals you do that are 10 times that size, but you're not like efficiently positioned to do those deals, I would say you continue to focus on doing the deals that you're good at. Kind of like an 80-20, and I even like to say 90-10. Like
Mhm.
90% of your time needs to go into that more bucket. The more, you just said it, and I like the analogy, the more of what you're doing that's working versus like the 80-20 is actually kind of flipped. They're like, do 80% of the work, give you 20% of the work gives you 80% of the results, whatever. Hey, if you are flipping 10 or $20,000 lots, and then you want to start going flipping $250,000 lots, it's not like you just wake up and it just starts working. You need to put the pieces in place. And really, you need to become confident in the deal, or you need to have partners that are confident in the deal, and you need to have efficient access to the capital to do those deals. And so if you're someone in that position, and I could go back to myself in that position, I'd be like, dude, these deals are making you a lot of money right now, or they're making you good money. If you like put the blinders on and define what a lot of money is, why would you do anything different? You got the system set up. And that guy I told you about at the beginning, I talked to him 6 or 8 months ago, still doing deals in those two counties, still doing
Killing it.
five to 800K a year. And
Yeah.
so there is no reason to have to go do bigger, have to go do better. I think the market will push you there eventually whenever it's time. But if that's not the case, then I don't know why you would change what you're doing.
Mhm.
And it's a
Yeah.
very reasonable, sorry, last thing on that point. People think that if you're doing 1 or 2 deals a quarter or 3 deals a quarter, that it's like, okay, well, I need to be doing 6 deals a quarter. So like next quarter, I need to do 6 deals. It's not a linear progression like that. If you're doing 2 or 3 deals a quarter, pat yourself on the back and say, that's great. And then figure out how can we do 4 deals next quarter? Or did we do 1 deal the previous quarter and then 3 deals this quarter? And then we have 0 deals in the pipeline next quarter. Maybe we just focus on how do we efficiently do 3 deals a quarter. A lot of people top tick the numbers and the stats they give out on the internet.
Of course, yeah.
And it's like, how efficiently are you doing that? And how often are you doing that? Because if I could do deals like I'll talk about some of the deals we're doing right now. If I could do those deals once a week, I'd be, everything would be bigger, you know? But it's hard to, and it takes time. I just say stay efficient, stay focused on the things that are working, and don't go run off and just start doing brand new things because somebody on the internet tells you to.
That's great advice. There's so much information out there about land and so much quality coaching and videos. And so that's a double-edged sword. With that information can also be dangerous because you can be popping around trying too much new stuff when, man, if you just got the Land Geek book from the decade ago and just put your head down and didn't pay attention to anything else, maybe you'd be, crushing it.
Yeah.
Yeah, that's interesting take. So with the cash and the cash management, how do you think about JV deals fitting into that? Because if you think about the complexity of a $10,000 profit deal versus maybe your a $50,000 profit deal, it could be a similar complexity, could be in your wheelhouse. Your efficiency of cash could come from a JV deal. Do you think that's a good way to leverage money, get land investors' eyes on it? Is that, yeah, what's that intermediary look like for cash?
So two things. One, I need to have as many clips out of me saying this as possible. So I'm going to say it on this podcast. Okay.
Yeah.
There has been so many people that are taking, because it's a logical step to think, okay, maybe I'll go to a bank or go to an institution. And if you're Clint Turner like 7 or 8 years ago and you went to the bank, they just laughed me out the front door. So for some people, not like it's not even an option. But for a lot of people that listen to your show and that follow me, you could probably walk into a bank and assuming you got some equity in your house, you got some cash, you got some stocks, got some retirement, like you could tap into lines, right? Pre 2020, there were some, and I say some as a percentage, maybe 20 or 30% of deals you could do that were pretty minor land development, land flipping type deals, where you could go to an institution and you could get non personally guaranteed debt. This was pre 2020, pre that little banking collapse that everyone's already forgotten about. It was pre that. Okay. You could go maybe 1 out of 4 times if the deal was great, the bank would write it as an asset loan versus a personally guaranteed loan. Post 2020, banking reforms happened again. I think there were like 12 regional banks. I don't know what the count ended up at, but a lot of them more or less got consumed by the federal government because of their poor lending practices. A lot of regulation came down. What the banks were actually doing is they were tucking these things in farm and ranch loans. And there were some little loopholes that they could do to where they wouldn't be personally guaranteed. In the last 2 years, I have not seen a single land deal. It could be like a $2 million deal I'm buying for $100,000 that the bank is writing, like they're not writing against the asset, they're writing against you. Okay. And I've seen a lot of people take that strategy and it's worked for them. Okay. It's been a great 3 or 4 years and it's worked for them. I don't think that's going to be the case going forward. Okay. And the more, if you listen to smart people, you listen to people who have been through the '08 recession, you listen to people who have been through .com, kind of 2000 era recession, you listen to people who've been through the recessions in the '80s. Every single one of them talks about how bad land got wiped out and how a lot of the people that went broke had personally guaranteed over leveraged loans against land because land values are one of the first things to kind of go to bottom when there's a major recession event. And so, not saying there is going to be, don't know when there will be. Data always says that there will be another one eventually. And so, I think it's a really bad time, especially with the uncertainty and everything right now, to be levering up. All right. So, unless you got a big balance sheet and you're smart with like financial risk management, I would not be like taking personally guaranteed loans. So that's the first thing to lead me into the second point of man, I love doing a good JV deal. Okay. JV deals are what got me into doing like all the different types of deals I do now. Because I started through that book you're talking about, flipping little squares in the middle of nowhere and seller financing them for 0% interest, which I did a calculation, by the way. If I had just charged 9% interest, or actually, I think I did 7.9, because I'm pretty sure I could have gotten every loan that I ever sold as 7.9% interest. I lost about $1.2 million in,
Oh,
in
wow.
equity just on my Colorado portfolio, not including everything else I've done. So bad advice, don't do that. But all that aside, I still did okay. Man, I love JV deals. I've given a lot of money away. I've calculated over time, I've probably given $5 million away in JV deals over my career so far. Probably more, I think.
Nice.
But I've always very much been like, I want, if there's somebody that's doing this next thing, and like people talk about subdivides a lot right now, but if people are doing subdivides, people are doing minor development, people are doing major development, people are doing title deals, if people are doing whatever niche or facet of land or real estate that you don't know, I'm a huge fan of doing JV deals because if I go to a funding partner and I bring a great deal to the table and they bring all the money, okay, yeah, I'm giving away a lot more of the deal than I would with a traditional bank, but I go to bed sleeping well at night. If the deal falls apart, our agreement says investment contains risk, right? And it's not that you're guaranteeing Clint's balance sheet against it. And so not only do you get to learn from operators who are familiar with writing bigger checks or doing different style of deals, whatever it is, you get I think like the personal financial safety that comes from it. And land is a game that there's a lot of influencers coming into it, a lot of people talking and selling courses and stuff these days that really, in my opinion, don't grasp the risk that is associated with it.
Mm,
It's been a great market since 2016 when I started. Okay. It is shifting the opposite direction. All
mhm.
right. And everyone sees that some deals are harder to sell, some markets aren't absorbing land as quickly, a lot more people doing the business. And it's like everything sets up to where there will be a correction. It is really hard for asset values to double over the course of a couple years and not course correct back down. And so I think that there is going to be, I don't want to call it like a recession or like black swan event, but there's just going to be a correction, right? And I think we're in the middle of it, frankly. And so I think people are going to get stuck in that. And so if you are in the position in your business where you're growing and you're trying to figure out what are those steps to do, I am a really big fan of working with JV partners on call it quote unquote 50-50 basis if it's something you're not familiar with. The caveat I would say is if Brandon's bringing me 10 deals a month that are consistent, like two baggers. We buy for 10, we sell for 20, and it's just consistent, right? And I'm doing nothing but writing a check for the same asset class with the same risk. I think you should probably have a little bit of the pie shifted your way. I didn't when I was doing it, but I think I could have. I think I could have asked that and I could have gotten it because of the consistency of deals and results I was bringing to my financial partners. So to answer your question, long story long, I think it is really advantageous to take the half a watermelon is better than a whole grape approach
Mhm.
and to work with people. If you want to go do a subdivide, bring a great opportunity to a good operator, right? Get like my first subdivide, dude. My first deal I did that was over $1 million, had a value add subdivide component to it. I think I took home 32% of the net on that deal.
Mm.
32%. Okay, so like I gave up like almost 70% of that deal.
Yeah.
And it probably was a little if you take up the amount of time and energy and worry and everything I put into that deal, like it probably was a little bit less than that. But anyhow, I took home a third of it, less than a third. And I was happy with that. It was still 300 grand. It was a good
Yes.
deal. And I was like, whoa, like this works. My confidence went from 0 to 100, right? 110 because I hit this big check, made my financial partners a lot of money. They were like, how can we reinvest? We're ready to go, right? And so that was a huge step for me where I grew my business and I grew my net worth and I grew my ability to do more deals, do bigger deals. And it was because I wasn't afraid to just say, whatever, take as much of the deal as you need to get this done. I want to learn and I want to see this deal go full cycle. Also wanted to see if are we all just like full of it and we don't know what we're talking about, right?
Mhm.
Because if these deals are real, like I want to do more of them. And so it's kind of like breaking in. And I think as people who are training themselves to go find great opportunities, that's the hardest thing to do in real estate. You should be if you have big opportunities, you should bring them. Man, one thing I wish I could do, I can still think back to this. There was a 800-acre parcel in Costilla County, Colorado. Okay, it's this beautiful, like nice rolling hills, road frontage on all four sides, and some internal road frontage. And I think I could have bought it back in the day. I don't remember exactly what it was, but I think it was like sub 200 an acre, $200 an acre. And I think now, like if I would have cut it up just into simple subdivide into 40 or 80-acre tracts, I probably could have sold it $1,000 an acre. And that's probably very generous, like on
Wow.
the low end. But I didn't know how to do it back then. I was like, oh no. And I just moved that deal along in the CRM, closed it out, and continued on my day. If I had just brought it to somebody, 'cause I didn't do anything with it anyway. If I just brought it to somebody who's like, hey, this deal came across my desk, too big, I'm out. Here's the leads info. They're very motivated to sell at $200 an acre. And I'd gone to do that to 10 people and or however many. And I was like, if you get it done, just give me 10%, right? Or
Yeah.
give me a fee or something on the back end, have fun with it. Man, I probably would have made so much more money. I would have met a lot more people and I would have started doing bigger deals a lot quicker. So
Mhm.
I'm a big fan of the partnership side. People get stuck in the 10% and the 20%, like how much more, like how much equity do we give up? Land is a risky game. And asking, especially in this market, asking somebody to give you a lot of money for a land deal, I think it carries a lot more risk than most people really understand. And so give the person what they're asking for, especially if it's a gateway to get you to like the next level of doing deals. Huge proponent of that.
That's great information. There it sounds like there's some fat tails in land, as Nassim would Taleb would put it, but where we underestimate the risk that's associated because of this nice market that's been around for 8 years or however long it's been. What do you think? So there's hedging your risk, just being aware of it, not personal guaranteeing, being reasonable with JV deals because take into account that risk. As the market has turned a little bit here, what do you think the opportunity looks like in land, or how's the opportunity shift? Obviously, you can start possibly picking up better deals, but then it's harder to dispo them. How do you think about that? Like, where's the opportunity lie within that? How careful do you want to be about sweeping the floor, picking up a bunch of deals because they're cheap, but then not take into account that they're going to be harder to resell? Like, how do you factor that in your mind?
So when I started in 2016, flipping unusable land in the middle of nowhere. Okay, and I say unusable, it's usable. It's just it's more recreational than anything.
Mhm.
And I think everybody thinks this when they start land. They're like, "Who in the world is buying this?" And that's what I thought, and really until I had done a few deals, frankly, like, even a couple years in, I was still like, "Why are people buying this?" Like, what? I get it. It's lower cost, it's they can't afford stuff closer to the city, et cetera, but there's a real especially if you're unfamiliar with the marketplace, like, who is buying this land? And so, back in 2016, 2017, and again, all the way up really frankly through today, like, the market's been great. There's been a lot of money out there. If people wanted they wanted another car, they wanted a tract of land, there was discretionary spending money available. And in my opinion, that's where a lot of recreational type properties fall into. They fall into, like, discretionary spending budget,
Hmm.
okay? Because you're not living on it most of the time, you're not living on it. And if you are, it's in a different bucket. It's not discretionary spending. It goes into a housing bucket, which is like hierarchy of needs, first one or second one or whatever it is. So like completely different bucket of capital. So I think about as the market is shifting, I'm thinking about where do we do deals? How do we do deals? The number one word that comes to mind is liquidity pools. Like, where is the liquidity right now? Okay. And I think that depends a ton on the market you're working in. I think it depends a ton on the types of deals that you do. Again, the types of capital you have access to. But what I'm thinking about right now is where's the liquidity at? Okay. And it's still a question I'm trying to answer right now for land. There's, you know, again, there's different buckets of where does land fall into, right? And stuff that is like housing related, that like roof over your head, to me is working a lot better right now than recreational land because there's a true use component to it versus a theorized use component, right? And as the market softens, the first thing that goes away is discretionary spending budgets, right? Like call it a house, a car, a boat. My friend Justin Sleva calls them the bass boat properties. Can you afford the payment on a bass boat? Well, then you can afford the payment on the piece of land, right? It's like in that same bucket of consumer spending. You can afford your $800 bass boat payment. You can afford the $800 land payment. When the market tightens and not as many people are buying the boat, buying the extra car, i.e., buying your properties from you that you're buying and flipping and selling, that bucket of money dries up a little bit. And so I think it's important to figure out in your market where are the liquidity pools. Where I'm seeing them right now, things that are more closely related to housing. Okay. So if you can think like entitlement land, if you can think about land that's closer or within city limits that is truly like the day you close on it has a clear path to being built into a house or a home or apartment or whatever, right? There's because a lot of that comes from institutional capital, right? When subdivisions get built, it's oftentimes financed through the bank, which is institutional capital because it's subsidized by the government for home loans, right? When we just sold a lot in Houston, it was a tear down lot. We bought it for 40 grand, we sold it for 200 because somebody had $1 million construction loan to tear the existing house down and build $1 million home on it. That was the liquidity bucket. It was tied into that. Versus if I was going to sell the property 2 hours outside of Houston, I need somebody who's just looking for recreational property and isn't affected by, you know, inflation and tightening budgets and all that kind of stuff. So I think it's really important to figure out where is the liquidity in your market. Up until now, there's been an immense amount of liquidity in the market as a whole. So if you're going to sell something that has a recreational use case, it's kind of fallen into the fact that everybody's had money over the past 7 years. And I say that as a holistic statement. Not everybody's been as blessed, but it's been easier to spend money. It's been easier to get access to money. And as we went through COVID and land values went way up because sellers typically lag a few years behind in land because they're old and it takes time for like them to catch up to the market. And budgets have tightened. I think like recreational stuff has been harder to move. I think that's what a lot of people are seeing. And I've seen as well with a lot of our deals. So I think really thinking about where's the money, right? Where's the liquidity in your market? And like where does land fit in there? So that's where I think about it right now. Very different, very market dependent on what you're working on. But wherever the money is, that's the markets that I want to play in.
Mhm. And if you're an investor who has a small portfolio of some of that rural recreational land, what are the tactics to get that sold, getting out from under that? I mean, looking at owner financing, lowering the price. I mean, how do you think about people managing their dispo portfolio?
I have had a lot of conversations about this lately with friends and colleagues, and just it seems like everyone's struggling with this. And I'm about to try to figure out what I need to do because we just did an audit of our loan portfolio, and man, I was looking at something and I was like, we are like my master spreadsheet. I'm like, we are missing some properties. Like,
Mhm.
I just know there's properties I own that aren't on this spreadsheet. And we went and looked and found a few properties that weren't on the spreadsheet. So I have 10 or 15 rural properties right now that I'm trying to get moved after not really doing a lot of super rural stuff, I will say. Okay, 2, 3, 4 hours away from major or secondary metros. I think you got to go back to the playbook that's always worked is owner financing, right? And I think I'm more mature now in this business than I was when I started. And so as I look at it and I say owner financing, I'm not necessarily thinking I'm going to keep all the payments and the loans. Like maybe I need it or a listener needs access to the liquidity in that portfolio. That might just be thinking about doing the loans correctly. There's plenty of discount cash flow buyers out there. If you like, there's Paper Stack, there's 1,000 different Facebook groups where there's a ton of note buyers that are in there. As long as you look at and you do your seller financing correctly. So to answer your question, I think it's seller financing and lowering prices to really bring in like the affordability aspect of the
Mhm.
property. Because a lot of people still want to, like I've proven to myself, plenty of people want to buy rural land. It's just depending on can they afford it. And just because you overpaid for a property, or just because you bought a property that you didn't expect you had to sell on terms, market does not care, right? Market could care less about that. We just are where we are. And if your property's not selling, it's either not priced low enough cash or there's not access to liquidity, right? Seller financing is a liquidity pool. It's just you, but it is liquidity, right? And so there's no liquidity there. And I think that the secret to getting stuff sold is what I did back in 2016, 17, 18 is just beat the market on pricing and financing. That always gets things sold, frankly. And I think the tweak you can do is if you're in that, because a lot of people are in the ballpark of, I bought a bunch of land that I thought I was just going to flip for these exorbitant prices that have now come down, and I can't seller finance. I'm gonna be underwater. You need to really focus on seller financing it properly. Good interest rate, good borrower. Simple. Okay.
Mhm.
Good interest rate, good borrower. And maybe one third one is like good loan to value, right? So if the property's worth 100 and you get 25 down or 20 down or whatever, you want to be kind of like a note buyer. Because at the end of the day, if you need to sell these notes, you're going to be talking to note buyers. Note buyers love to see sub 70% LTV, right? So if there's $100,000 of property value and there's $75,000 of unpaid principal, there's only 25% equity in that portfolio. A lot of buyers want to see 30% plus just because it hedges the downside risk, right? If the market does adjust 30% down, that note buyer has a big cushion to land softly, right? And
Mhm.
still get out of it evenly. So that might mean that you take less money. That might mean there's a lot of consequences that it could mean, right? But at the end of the day, that's what note buyers are looking for. Good borrower, good loan to value ratio, and I don't remember the third one I said. Something else, right? But that's really what we think about. Good interest rate, good loan to value, good borrower. And maybe even a fourth one, decent asset, right?
Mhm.
Understand what the asset is. If it's a bad asset, just say it's not a great asset and expect to sell it at a further discount. Like when I go look at, I get people send me notes all the time. If I'm looking at a lakefront buildable property that's got 50% unpaid principal. Okay. So I've got 50% equity in this deal. And I'm buying it at a cash flow discount of 10, 15, 20%. Call it 15%. And then I go look at an 80-acre tract in Costilla County, Colorado, where your market value versus my market value change. Like I'm going to be very conservative. You're going to be optimistic about what the market value is. And so if I look at it and I'm like, dude, like even with the down payment that you took, I think that the unpaid principal amount here is about what the market value is, right? If the market corrects, borrower stops paying, I'm underwater on this deal. I would much rather just go pay more money for the lakefront lot, for the loan
Hmm.
on the lakefront deal, than deal with this one. And there's always a number, right? If I can give you half of what you're asking for, so I have that cushion, but that's probably not going to be good for you. And so for people who are stuck with the inventory, I think it's just thinking strategically about how do you lower prices in seller finance? And if it's more than one property, because I, I was talking to somebody about this yesterday. There's different note buyers. Okay. If you're familiar with like real estate debt and you're a personal investor who's say sub $5 million in net worth, man, I tell people if I ever want to just quit working for a year, I'm just going to take my cash. I'm going to go buy land notes because I can average about 18% yield on those. I'm just going to hang out and just harvest my 18%. So there are people like me who buy notes just purely because it's much higher than inflation. It's much higher than market, what I'm going to get in the S&P or what I'm going to get with Goldman or whatever, and I understand it very well. So I'm kind of like a personal buyer, right? And then there's this big gap in the market, and then there's like institutional buyers. And so you need to realize who you're targeting. For everybody, one $8,000 loan probably isn't going to get anybody out of bed, right?
Hmm.
A portfolio of 12 $8,000 loans that are $100,000, that's going to wake you up to take a look at it further, right? But on the flip side, a large portfolio of $2.5 million, too big for me, right? It's too big for me to go take down unless I go raise the money. And I don't really want to do that to harvest 2 or 3 points in the middle. So then you're starting to talk to larger funds, more institutional sized buyers. And frankly, they like to write $5 million checks. So there's kind of this gap in the market too. And you got to realize where you're playing, right? So you want to package your deals up into a size that makes sense for the person that's buying. Because like a lot of people who are new to it, they're just thinking about it as individual, like as individual properties. Oh, I got these 4 land notes. But as the other side of the screen or the other side of the buy the this equation, the buyer of the debt, they're thinking about it in completely different terms. How much money am I laying out? What's my cash flow? What's my yield on my cash? And so I think thinking about your inventory and how you're going to discount and sell it on potentially seller financing, you should also be thinking about who's going to buy that portfolio on the other side, right? I think a really good sweet spot for people is to create portfolios. If I were to go sell my note portfolio off right now, I'd break it up into $100,000 to $200,000 chunks. And I'd put some good assets in there, I'd put some medium assets in there, and I'd put a couple bad ones in there. Or quote unquote like the less desirable ones. And I'd break it up into chunks like that, and then I'd go sell the individual chunks on the market or to buyers that I know. So that's how I think about it. And if I was stuck with inventory, I'd be cutting prices to beat the market, and I'd be seller financing smart.
And when you talk about good borrowers, how deep do you get into the financials of borrowers? What's a good borrower look like?
Consistent income for 3 years, 650 plus credit score, no serious delinquencies on their credit report. Like past delinquencies are generally okay if they're not within the last few years, but no current serious like active delinquencies. That's pretty much my check. You can There's 2 ways to do this too. You can self-originate, which means you're looking at all these docs yourself, or you can pay somebody, an RMLO, like a residential mortgage loan originator. They often will take on onesie twosies. So there's, I think Texas Pride Lending is one of them in Texas. I think I'm getting that. I could be getting that wrong, but that's who I'd go to. Whatever the name of it is, I send it to you after this for your show notes. But if it's a larger property, generally, I'm gonna rule that as like $100,000 property plus, and I'm selling it on seller financing. I'm gonna have the loan originated. Okay, so I'm gonna do like a professional origination, and they're doing the same paperwork packet that a bank would get, right? And they're gonna give you the same summary of the borrower as the bank would get. And I'm gonna make the buyer pay for that, right? I'm gonna say, yes, I'll extend these great financing terms to you, but you got to pay this $950 origination fee so that Texas Pride Lending can originate you. Hey, by the way, do you have these 3 things? Are you a 650 credit score? Do you have consistent income? Do you have serious delinquencies? Because if you do, this probably isn't going to work, right? But if you don't, great, pay the 950. I'll get the report back. We'll be good. If it's a smaller property, I like to just ask people. I give them the option. I say you can go pay for this $1,000 report, or you can go pull your free credit report from Equifax or freecreditreport.com, and you can send it to me, right? And I can just make a determination through there, as well as as well as paycheck stubs or like income statements to show me like, do you consistently receive income every month? So that's what I mean by looking for good borrowers.
And is that cutoff point $100,000? Is that a fairly standard cutoff point for you, whether you're doing that yourself or having it originated, or how do you think about that number?
If I know I'm selling the loan or I know I'm planning to sell it in the next year, I'm gonna originate that, and I'm probably gonna
Mhm.
originate it even like below that number. If it's a really great deal that I'm doing and I know I'm sticking it into my portfolio that I'm not selling, because like sometimes you do a deal, for example, like we bought a deal for $15,000, I think 3 months ago, and we sold it on a note for $218,000, right?
Nice.
So like I could go get the liquidity to that, but the returns are basically infinite with the down payment on it. And let me take that back. I think that property cost me like 35,000 after we paid some judgments and liens and taxes off on it. But it's still a very good return. That's one where I can stick it in my portfolio. The return is near infinite. And so I might be a little bit less lenient. In fact, I was less lenient on seller financing that one than I was on a deal where, for example, when I do a subdivide and I model out, okay, if I sell 20% on loans or 30% on notes or whatever, I need to understand like how much do I need to go take to the market to sell to get the cash back into the project to pay off the investors, pay our investment returns, and everybody makes some money, right?
Mhm.
Very different ways I think about those two deals. So it's not a hard cutoff. And in a perfect world, I'd originate every single loan, but it's like more paperwork and more time and more steps and more emails and all the shit that you have to do.
Mm.
And I think it depends on really if you're going to sell it or not. But it's never bad. It's really never a bad thing to have a loan professionally originated if you're not familiar with doing it yourself. But it's going to be somewhat cumbersome if you're selling a $10,000 property and you need somebody to spend $1,000 on the loan origination because that's what it costs, or like it's going to cost somewhere in there. It can become price prohibitive at some points. 1% of the purchase price at 100K generally makes sense. 10% or 5% of the purchase price, I don't know if that makes sense. Maybe I'll tell them they can do it, or they can just send me their credit report, right?
Yeah, that makes sense. So you're thinking about what you're gonna do with that property. You have to sell some of the notes, or are you just gonna hold it? And you referenced that one that you had 30 bought for 35 grand, sold for over 200 on a note. That's something that you didn't originate. You're saying just because there was so much equity, it's whatever, even if this person gives it back to me, I'll just do this again. So that was
There
the
was a
thought
lot of
behind that?
equity. Yeah, there's a lot of equity. I didn't plan on selling the note. And what was the third thing? Oh, sorry, is I got such a large down payment. Like sometimes in my mind, if somebody's bringing a substantial down payment, like 30,000 bucks, I'm a little less inclined, right? If I tell them the terms, and they're good, beneficial terms to me, and they're bringing a big down payment, I'm sometimes less inclined to make them jump to the hoops to originate, right? Because it adds time. It adds like a week or two to the sales process,
Mhm.
and you know, people's desires to buy change pretty rapidly at times. So when the situation's there and the opportunity's there, and that deal had a couple little thorns in it that like that property could have been. It's probably worth more than 218 what I sold it
Mhm.
for. But they're going to deal with some of the problems that were on the property. I felt comfortable talking to the buyer. They brought enough cash to the table to where I just didn't feel the need to originate that one. Big down payments help, I would say as well.
Yeah. Yeah. What do you think of you mentioned this earlier in the podcast that there's more people doing the business now. How has that affected or changed the dynamics of how the how people should be looking at land?
I think the biggest way from a land business owner standpoint, that's the perspective I talk from. As a land business owner, okay? I don't think it really changes anything if you're just a onesie twosie investor and you don't run a land business. There's a huge difference between somebody who does 3 deals a year and somebody who runs a land business, has payroll, has staff, has resources that are consistently day in and day out going to the business. So I think the perspective changes based on where you're at. Now, if you're in the land business, Brandon, will you ask me that question again?
Yeah, so there's more people in the land business. There's
Yeah, okay,
great
I got it.
information, yeah.
Sorry. I was ranting and then I was like, wait, what? What did he ask me? And if you're in the land business, I think the number one thing by and large I've seen that's changed is that you need what we're doing right now. You need a network presence. Because think back to when you started the business and those bigger deals came across your desk, right? Or when you had done those 2 deals the quarter and you're out of money. There's a lot more people talking to sellers, and you run a cold calling deal gig, right? Where you talk to a lot of freaking land sellers, okay? Their sentiment changes with the wind. Their desire to buy it, to sell changes with the wind. And sometimes, man, I've been so blessed and gotten so lucky on some deals. And I've tried to science it out and figure out exactly what I did. And sometimes I cannot come back to anything better than right place, right time. They liked how my voice sounded.
Mhm,
I don't know. It's just what it is sometimes. And there's a lot of people out there talking to land sellers right now. 80% of them can't close or do the deals, right? So I don't really view more people coming in as bad. I think if you're unwilling to adapt, it probably is bad for you, right? But man, I'm doing a lot of deals lately with people who are newer in the business, right?
mhm.
They're bringing, and I'll say a lot relatively because the type of deals I do are a little different now, but there was a period there where I was doing almost like in 2021, 22, I was doing almost every single deal. It showed up in my inbox through a DM, through an email, through a phone call, through a text message,
Wow.
because there were so many people out there that are doing the hardcore prospecting work. They're paying for the cold calling service. They're spending the money on the direct mail. They're doing the riskier text and voicemail type stuff, right? That's hard. That's a lot of work. And it creates more voices in the seller's head. And it really just makes it a little harder to get lucky. That's how I think about it. And so,
Mhm,
with more competition, more people talking to sellers, I think you need to open your doors and be ready and able to work with more people. And it's gonna be counterintuitive, and it's not like the easiest thing to just do day one, but it's also a pretty freaking easy thing to do, to just network. And so I think that's a huge thing with more people in the market. I think you need to have a bit of a presence. And dude, it can be micro. Like I know some guys, like I was talking to a guy the other day. He said my marketing spend is gold watches. And they're nice watches, and he sends them to colleagues and friends and people that he knows. And I had this gold watch up on my door one day. I was like, what's going on here? And I look at it, I see who it's from. I'm like, that was a really thoughtful gift, right? Now I talk to that person a lot. They've done a lot of business with me, right?
mhm,
And he sends meat packages out, and he sends knife sets out, and he sends baby gifts when your baby's. He's focused on networking. His marketing spend is the gifts that go out. It's the thought that goes out into maintaining the relationships. He does zero marketing. His deals come
mhm,
through that. You have a presence here. I've been on the internet for a while talking about this stuff. So stuff comes to me. So when it's like we're talking competition, it's been great for me, frankly. I've just had more deals coming to me. That's something you can't ignore, something you need to do. Now, let's talk more practical things. I think you need to make sure that your marketing spend is within check, right? Marketing costs have gotten out of control. It's really easy for your results to go down and your marketing spend to double and triple. And all of a sudden, you're like, where did my money go? I think you need to be really tight on your budget, your financials. And I've been preaching this for a couple years now. If you don't have the money to mail, then pick up your damn phone.
mhm,
It is almost free to go find land records and to call them yourself.
mhm.
Most people just won't do it because they don't want to do it. But there is no cost there. I'm really focused these days on marketing channels that require less money. Okay. They
Yeah.
require, so I don't have to spend 20, 30, 40 grand a month on mail for deals to come in. When that strategy worked, it worked amazing. And I would love to spend that 40 grand a month. But now it's a little more challenging. You almost got to get lucky. And when you do get lucky, it's great. But you got to get lucky on that spend, I think. There's less just of a business mechanic there. And so I think you really got to tighten in and dial in your marketing to be within what your true budget is, right? What you truly have available to spend and burn, because marketing spend is not guaranteed. Everybody says land has a XYZ ROAS. There is no guaranteed ROAS in land. It depends on
Yeah.
if you catch the seller on the right day and the mail's sitting at the top of the pile or whatever it is. So I think being real cognizant on how much you're spending on marketing and how you're finding deals and how you're pricing deals is the last thing
Mhm.
I would say.
Mhm.
Um, man, looking at comps from the last 2 years, like we don't do it. I don't do it on my team. Like, if it was if it has a 2021 or a 2022 on it, it's like it's an outlier set of data to me. I look
Mhm.
at 2019 and 2020, and I look at what's pending under contract right now, right? And then the third thing I'd say that I think is really important to look at right now is what's active, right?
Mm.
There's a lot more. I did a presentation November of last year, so I don't know how much it's changed since then. But I think the outcome of that presentation that I showed is that there are 500% more land listings online available for buyers right now than there were for the couple years prior to that. I think the areas I looked at, it was like, hey, in this market, there was 180 listings between 50 and 1,000 acres. And then you fast forward to right now, there's 1,100 listings on the market, right?
Wow.
It's like the supply, the available amount of stuff for sale has gone to the roof. And so you just need to be very micro focused on your markets, right? If you're going to list in a market like I just described, where there's significantly more activity than there used to be, where prices have really shot up, you need to understand what is going pending right now, right? What is going under contract right now? Where are people spending money at what price points? And how can I come in and look at all the active listings on the market? How can I come in and undercut them? Because if you think about Zillow and you think about Redfin and Realtor and Land.com, the stuff that pops up on the map, which is how most people search, by scrolling through the damn map, okay? The stuff that pops up with the little stars next to it and like really displays itself so you click it is the stuff that seems to their algorithm competitively priced so
Mhm.
that you'll spend more time on the app and you'll potentially book a showing and they get paid from it, right? Or they sell their marketing service or whatever it is. So you need to be very competitively priced so that the algorithms pick you up and actually show your property, right? If everything's listed at 12,000 an acre and you list at 12.5 an acre and your property doesn't have beautiful waterfalls and rolling hills and trails and barns and shit, like it's not going to get seen. It needs to be listed below what the most recent similar tract that is under contract is for it. That's going to make it show up in the Zillow algorithm. That's going to make it come up on land.com. You're going to get more traction. You're going to bring buyers in a lot faster.
Do you have a system or a rule of thumb you use around that, like a price 10% below the current lowest price, or do you have anything systems around that, or just kind of coming in somewhere below that's competitive?
To me, it really depends on the feature of the property,
Mhm.
the feature set of the property, especially if we're talking recreational. Okay. Development type land is a little different bucket, right? But if we're talking recreational land, a flat field versus something that's nicely covered, it's got good trees, it's got mature trees on it. You can envision hunting on it. You can envision camping. Like those are different properties, right?
Mhm.
And people want the latter. They want the thing that is more feature-esque. Okay. Not many people want the 10-acre rectangle that has all pasture. So I think it depends a bit on the feature. If you have a property that really shines from a feature standpoint, then I'm a little less inclined to do heavy discounts, right?
Mhm.
But the truth is 80, 90% of the deals that you do aren't that, right? And so I just want to be like, if I can see everything's listed at 10,000 an acre, and I can see there's 2 or 3 properties under contract at 9,200 an acre right now, or whatever it is, I wanna be at 8,900 an acre. I wanna be at 9,000 an acre, right? I want I think, and this is just one man's opinion, but I think if you're not listing your property with the intent to get offers in the first week, then you're not buying it right, and you're not doing the business correctly,
Mhm.
alright? Unless your strategy is different, unless you're holding for a long period of time. But most people we talk to, most people that are in this business are in the business to quickly buy and sell the property that they're acquiring, right? And so that's how I think of everything is I want it to go to market in a fashion where there's going to be a bidding war. And
Mhm.
worst case, we just get an offer or two. But sometimes an offer or two is like a huge win in some really competitive markets right now. So if I go to market with a property and we're not getting an offer in the first 2 weeks, we did something wrong. We need to relook at price, how we're selling the property, maybe just come to terms with, man, the amount of people that buy shit, sorry, the amount of people that buy land and they sit on it for 6 months because they're not getting the price they want drives me absolutely crazy. I cut ship on my properties like more times than I care to mention. I sell things for marginal gain, marginal loss. I think about it a lot more like just trading widgets,
Hmm.
right? Like I'm speculating that the widget's worth this much, and if I take it to market and I'm confident I marketed across all the platforms and it's being seen and I'm not getting somebody to buy it, then I'm wrong. Simple
Hmm.
as that, right? I am incorrect. Slight adjustments for it's hot as hell outside or it's Christmas time or it's whatever, right? But outside of that, like if I bring it to market and I'm not getting offers quickly, then I just did my thesis on the deal was wrong. So I need to come down on my price or I need to do whatever. I need to move towards a no lower price sale to get the thing moved. And that happens. That's a very common thing to happen. I think the important thing is to get out of it so that you can bring the cash back into rotation and you can do more deals with it.
Yeah, there's a bit of a sunk cost fallacy there that keeps people like, "Oh, I need to get this back out of it." And there's some psychology from the trading that plays into it a little bit also. It's you wanna win that trade, you wanna make sure you win every time, but part of trading a widget is that sometimes you'll be wrong, and accepting that, learning a lesson, getting out of it without hopefully a big loss, cap your downside, don't hold on to it for a year, get on with it. You're going to lose
Mhm.
sometimes or not do as well as you thought. And there's a lot of psychology, I think, around that if people like kind of dig into it. But I think that your approach is right on. Go into the market with the expectation, hey, we need an offer on this and within 2 weeks or we did something wrong is a great mindset, especially as the market softens. I'm guessing that's even more important. I round up the show. A final question that I like to ask people is if you could put one message onto Twitter and everyone on Twitter would see it, what would you write? And it's got to land in the no threads.
What would I put on Twitter? Probably everybody could read it. You know what I would put? Because it would create a lot of controversy. So I would just put land cash flows, period.
I like that. Land cash flows. I like it. Now, give me a short explainer on that because it's quality.
Yeah. I mean, most people aren't familiar with our niche. And the reason I would put that is because a lot of people would say, no, it doesn't, because it doesn't have this or that, or it doesn't have a lease or something. And man, I don't think people understand how like M&A works. Like you buy businesses at discount to future cash flow. So if I buy a property at a discount to its future value, it does cash flow, right?
Hmm.
I can buy a 2008 Ford Mustang at a discount to its future value, and it's cash flowing, right? That's the
Hmm.
definition of cash flow. Land does cash flow. A lot of people would say it doesn't, therefore it would go viral, and everybody would argue about it. And then I'd be able to talk a little more freely about why I am like in my stage of my career, I bring a lot, I say a lot relatively. I try and do a lot of stuff with my own money currently, but I've also been blessed to have done some great deals over this, like over the last 8 or 9 years I've been doing this, build a good following, and have a hungry appetite for people to want to invest with me, right? And so educating people on what we do and how I can consistently hit our current fund offers like 15.4%. Like people look at it like I've had a ton of meetings about our fund and everyone loves the return metrics and they love the mechanism and they love the idea of land. But the problem is a lot of people don't get it. And so I would use that as a tool to teach people and gain followers and explain why land does cash flow. And it's a really great, in my opinion, way to diversify a portfolio that's heavy in tech stocks, heavy in commercial real estate, heavy in whatever debt product that you're into, S&P type market hedge, right? I don't think I have 8 years of data that I consistently outperform the market. And I think that there's a lot that could be done with a really big bucket of capital. Because, like I told you at the beginning of this podcast, I think the people that are going to do very well over the next few years are the ones that can move quick. I heard, who was it? I think it was, what's his name? Shoot, Chris Powers. I
Hmm.
heard him talking I think last year in his year in review that he does about why they were moving to more of a hedge fund model. And he said because there's a lot of great assets out there that they want to buy, that syndicating deal by deal, they were having challenge getting across the finish line. Because when you're competing with mega institutional buyers, they can, if they see an asset they like, they can underwrite it and they already have the cash. It's up to them to decide if they want to spend it. Versus if I go find a great land deal where I'm buying it for, I'm buying it for 1 million and I'm putting 500,000 into it and I'm selling it for 3 million. I've typically in the past I have to go syndicate that, right? I need to structure the deal with the seller so that I have enough time to go raise the capital. And frankly, half the time, by the time my due diligence period's over, I've spent most of the time raising the capital versus doing the due diligence for the property. And so I think people who can move quickly in this market are going to be at an advantage. And so that's why we're moving to a model where we I like to use my own money because I think land is like this cheat code where you can multiply your net worth. Like I'm 30, okay? I
Mhm.
never thought in my whole life I was gonna, and I'm not like mega rich, but I never thought I was gonna have money, right?
Mhm.
To the level I have now. And looking back at it, man, like it's all been because of land. It's
Mhm.
been because I've taken the cash I've earned and I've redeployed it into land and it's multiplied itself. And so I am still a big proponent of using as much of my cash as I can, but sometimes there's deals that are too big for me or I'd be over allocated into land where it makes sense to have a bucket of cash. And so I think people are going to do very well if they can find those deals and move quickly on them. And so I've been a little more focused this year on getting more efficient with our capital to where we can deliver great returns to our investors, as well as have the cash liquid and ready to go to be deployed as we determine versus having to call 10 investors every time I see a deal, present the deal, they take it to their committees. We have 100 meetings about it. And the whole time I really should be spending the time like doing land related due diligence instead I'm on the phone trying to sell the deal. It's my thought.
So ways to move, I mean, the main lever to pull, it sounds like, with being able to move fast is having cash ready. So the quickest way to have cash ready is it's your own cash. I would say probably the second quickest way might be a JV deal with someone. Is there a way to get cash ready in advance that's not no personal guarantees? Because I mean, you could pull a home equity line out or something, but is there a
Yeah,
way to get ready, cash ready to move quickly in advance?
there is. I think we glossed over the two things that I think most people are, it's most important of is your own money or JV money, right?
Mhm.
Because I use this, I was talking to somebody the other day who was asking me about a JV deal and growing their business. And I was like, you need to have your cash bucket, right? This bucket of if it's a quarter million, if it's 100,000, if it's a 500,000, if it's a million, if it's 5 million, whatever it is, right? You have your cash bucket so that when you see that deal that's buy for 100, sell for 300, you need to take your cash and put it in that deal as fast as possible because that is a net worth multiplier. And if you do that over and over for 5 or 10 years, you're going to be in a position that you just never really thought you'd be in. And that's my pitch. Is why I've continually been putting my money back out into great deals. The second or JV deal, so if it's too big or all your cash is allocated, you've got a partner that says, "Hey, if you find a deal that hits these great metrics, I'm your guy," right? And that's a relationship, that's something you work, but you have your bucket that you maximize, right? Like again, like just because you have $100,000 doesn't mean you should put every cent of it into land, right? You need to decide how you want to allocate. But I mean, I'm out of money all the time from my personal bucket. So I either got to
Mhm.
dip into JV partnerships or into the fund. And so I think there's two buckets there, right? You need to focus on your own and continuing to deploy the capital you have available, as well as having a mechanism or two or three set up to where you can get access to the cash quickly. I think a great JV partnership where you have clearly defined deal terms, they're vetted exactly. Yeah, exactly is a tough one, but you know how much cash they have available to deploy, and you have agreed, here's how much we're going to try and deploy together this year, right? Just because somebody says they're a big real estate developer and they have $20 million, learn from experience, does not mean they're ready to give you that much money or
Mhm.
even anywhere close to it, right? So you need to understand, okay, you want to deploy $1 million this year at these return targets we've got. Great. So now I know that's my $1 million bucket. And if I bring them deals and they don't deploy money into it quickly, then I'm not going to probably work with them in the future. So those are two huge things I think people need to understand. To answer your question, how do you do it without those two? I think it's really hard to if you haven't mastered those two first. I could be wrong on that, or at least gotten good at them. Because the third is you need a structure. You need like a fund, for lack of better words, right? You need something that allows you to pull the capital in and use it effectively, right?
Mhm.
So last year, I think I don't know, Q3 of last year, we set up I always mess up, and I shouldn't, but I always mess up on what the letter is. It's the non-regulated fund, so we're not advertising. Like, I'm not Grant Cardone on Instagram. Hey, wire me your 401k money, right? That's
Yeah.
not what we do. There's a vetting period. It's kind of like a friends, family, acquaintances type fund where the general guidance is somebody for 30 to 60 days before they invest with you, and they're an accredited investor. We have that fund set up where we can consistently take money over. You set the time period, but ours is a 7-year period. So we can continue taking money for 3.5 years into that 7 years. And so I can go out and I can talk to people who approach me first, more or less, about that vehicle. So if you're listening to this podcast and you're ever interested in that, you'd send me a DM and we'd have a coffee, and then we'd have a second coffee, and then eventually maybe we can talk about it. But and the reason we did that is because it's significantly cheaper to set up. It's a regulated structure, so there's not like funny business going on. Clear reporting, like everything you'd get from a publicly regulated fund. And it's just a version of, I think it's the 506 something, CED something to that effect. And we can continually take cash there. We actually have more demand than I want to take into it right now, but we do have that bucket set up. And I think when it comes to learning how that works, is to always be in the position I just told you. I just said is we already have more, like we have people who want to give us money more than we want to take, right?
Mhm.
I think it's really tough if you are trying to skip from, I did a few deals with my own cash, to now I'm starting a fund, right? There's a lot of like track record and relationship building and things that need to go on in there versus I have a fund, I have the amount allocated into what I want right now, and I have people that ask me if they can put money into it, right? It's a
Yeah.
good position to be in. And it's only because I've been doing this for a while. I've got a bit of a name built up and I've done a lot of deals. And so I have the track record. And frankly, like I just truly believe that our deals are so good that I want to deploy as much of my own money into them as I can. And that's a conviction I have that generally resonates with other investors where they're like, wait, but I want to put money in there too. You know what I mean?
Yeah.
So yeah, there's structures you can set up. There's different ways you can pull it. You could pull it into a fund. You could pull it into just like a purpose-built entity. There's different legal structures, but at the end of the day, it doesn't matter if nobody wants to give you the money. So hopefully that answers your question.
Yeah, absolutely. I mean, for most people, it's going to be really leveraging their own cash position and then having JV partners set up with loose predetermined terms where you can go get that money quickly.
Yeah. And I often tell people to date before they get married to somebody in that aspect. Like, hey, I wouldn't, like, if somebody came in my inbox and was like, hey, Clint, like, I have a great flow of deals. Do you want to do $1 million of deals with me? I'd be like, I'm probably not going to respond to that message.
Yeah. Yeah.
But I think being a little more organic about it, and as things come into your inbox and you have, like, man, I'd like to do deals with that person, right?
Mhm.
Of going to them, just starting off with a single deal. Like I talked to somebody the other day, they're like, man, this guy, he said he wants to put $5 million in my business, and I'm trying to decide how to take it. And I'm like, I know you want to take it, but you haven't done $5 million of deals in a year. One, and two, man, there's a lot of paperwork and a lot of lawyers and a lot of stuff that get involved when you start throwing money around like that. The investor generally, this isn't a all-encompassing statement, but the investor generally likes it when it's like, hey, why don't we just do a couple of deals together? We'll both go on title. We'll both be in it with our individual entities. We'll have a clear profit sharing agreement. And if we like how things go, then we can do something a little more formal, right?
Mhm.
And they're normally like, or at least how I've seen, they're like, oh, good, one less entity to manage, right? less tax things I have to deal with my CPA, very simple documents. I don't have to pay my lawyer or anything, or I don't have to pay him a ton. So it's easier to get in the door and get things going. And then if a few deals go well, it's like, hey, let's put something a little more formal around this. Like you've made $300,000 with me over the last 6 months. Do you want to deploy $1 million with me over the next year? 'Cause that's what I need to keep growing my business.
Mhm.
It's always easier to have that conversation after somebody's has proceeds in their account. And it's slow and it takes time, but I think that's the path that you got to take.
Wonderful. Anything we glossed over or you'd like to dig a little bit deeper into, or things we might have skipped in the podcast that you want to hit back on?
Man, need to there's no need to try and we didn't gloss over it too much, but I just want to hit it because it's the big word out there right now is like subdividing land.
Mm.
Okay. If you have a great operation that's making money flipping land, subdividing land is not like the game for you. Okay.
Yeah.
There are some very simple subdivides that I would caveat with that, where they're almost flips. They're like administrative flips, basically,
Mhm.
right? They're flips with a little more paperwork. But once you get into true development, it's a different business. Okay. It is not the same business. It's like you have an acquisitions arm and then you have a development arm. And the development arm has different roles and responsibilities, has different objectives, has different tactics, has different KPIs. And most people are just like, oh, I've been doing land for a year. Now I'm a land developer, right?
Mhm.
No, you're not.
Mhm.
Land development is very challenging. It's very, very time consuming. And there's a lot of cash that goes in. Like you and me are very used to putting 10, 25, 50, $100,000 as equity into a deal because we know it's worth a multiple of that. But what if you need to put 10 or 25 or 50 or $200,000 into not equity in a property? You need to put it into like architects and geotechs and
Hmm.
architects and all the techs and all the studies and all the everything. And you're like, huh, it's been 6 months and I spent $180,000 on this and I still don't have my approval. It's like just a whole different bucket, whole different world. So as somebody who did this, who I had a big win in 2020 from a subdivide, it was again, right place, time, owner, put this property under contract for 1.2 million. Had no clue where I was getting the money. That's the deal where I gave like 70% of it away, basically. Um, Sold that property for almost an exact double two bagger. Sold it for 2.4. Did well on the property, right? And I was like, I'm a land developer now. And
Mhm.
what actually happened was I caught a really nice upswing in the market where my plan was to develop the property, but the market was so stinking good that somebody bought the property before any development or any entitlements had started. And I was like, I'm a genius. I'm
Yeah.
going to do this over and over. And it's really just that we caught the upswing
Mhm.
looking back on it. Now, true subdivides and development plays, they're a lot harder. You don't just package them up generally and sell them. And you don't just flip things to home builders. You hear this from people a lot now. It's, oh, I'm working on this residential entitlement play and DR Horton's going to buy it from me. Bet you 9.5 out of 10 times you hear that, DR Horton does not buy that property. Okay. It's a hope and a dream that somebody lost 70 grand on.
Mhm.
And man, if you would just keep doing what's working and keep slowly chipping away at the progress, you're going to be a lot farther along in the end. You can still do the subdivides. You can still grow your business in that way, but I would do it smart. I wouldn't just kind of jump all into it. So it's all the rage right now. It's what everyone's talking about. And if you got something that generates consistent income and cash flow, you've got something that 99% of people don't have right now. And I would really focus on how you maximize whatever that niche is before jumping to the next thing.
Yeah, as a bit of a contrarian, you've got me thinking like it would be fun to just go to Desert Squares and just start doing the Land Geek model, just going really hard on that while everyone else is getting into simple subdivides and
Man, I think
like
about it all the time. I think about it because there's another well-known guy in the space who started right around when I did, and he never really stopped doing desert squares.
mhm.
And I was talking to him about his note portfolio the other day, and I was like, if I would have just kept doing that, I don't know. Like, I'm happy with how everything turned out, but I mean, he has got a massive amount of equity in a cash flowing note portfolio he's built. Like, we're talking 8 figures,
Yeah.
right? Which is, and it's just because he didn't get sidetracked. He just continued to build systems and you continue to focus on how can you be more efficient, do one more deal this quarter, do one more deal next month in the thing that was working. And when
Yeah.
it stops working, of course, you need to figure out a pivot. But if it's still working, man, don't run away from it.
Well,
Please.
you know what, Clint? Here's the thing is you're the quintessential entrepreneur. Like I reading about you did the iPhone repair in high school, flipping couches and ATM business. Like you're that guy. And I think that a lot of land investors are entrepreneurial spirited, and it's so hard to not keep growing into the next interesting thing. Like you've grown all the way into complicated, really complicated deals. You like hairy deals, as you put it. Like there's a reason for that. I think people are built for that type of progression. So staying in the boring thing that's going to pay off over time, it's just, I don't know how many, I can't do it. It doesn't feed my soul.
But what I always remind people is you started this business for two reasons. You started it to have more time and to make more money.
Yeah.
And a lot of times when I start talking about like the reason I'll go buy a $2 million deal, maybe $2.5 million deal for $600,000 outside of title, literally writing deeds on truck beds and with drug addicts under bridges and things of
Yeah.
that aspect is because like I've underwritten 1,000 titles in West Texas, Costilla County, Colorado, DFW. Like I've underwritten title a million times, and I feel
Mhm.
very good at underwriting title. And in the last year, I've learned that that is a strength that I can deploy into doing more deals.
Mhm.
And so I like those deals. There's a big high barrier to entry, blah, 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 blah. We can talk about that on the next podcast. But good gosh, dude, if I tried to do that 3 years ago, even like I would have been scared shitless. I didn't have the cash file sitting there. I just didn't, I wasn't prepared for it. And we got in this business to make money and have more time. I just had my first kid and being home, being able to just like, because I also have friends who are having kids that work jobs, right? My wife
Mhm.
has friends that have kids where their husbands work jobs. And the number one thing that she tells me that her friends say is, "Man, I wish so and so was home more."
Yeah.
And I'm like, "Huh, that's good. We don't have that problem."
Yeah.
Right? And I like that's actually why I started this business is
Mhm.
so that we could say that. And I know I want to make 10 million, I want to make $10 million next year and do all these deals and flip all these things and build all this stuff. But at the end of the day, we did this to make money and to have more time. And I think we got to refocus sometimes that maybe what you're doing right now is that, right? Maybe
Mhm.
you are making more money and you do have the time freedom that you were searching for. And it's just you hear us talking about big shiny objects. Don't get me wrong, I've made all the jumps, right? I've made
Mhm.
all the mistakes. But man, consistency is really it in this game, and especially in land flipping, buying and selling land as widgets. If you find it where it's working, just milk it. Like work it as long as you can until it stops working. If anything, build systems around it so that it's so damn boring that you have to go do something else. But if
Mhm.
you find a niche that's working, man, take it 1,000% all the way until you've maximized what you can efficiently like extract from that market, and then think about growing the business.
Mhm.
My take.
Yeah, that's a great way to think about it. Building the systems around it, putting people in place to implement those systems, and then working yourself out of the daily work. And then, okay, now built, you've put in the work, you've put in the time, you've done the grind. So you deserve to now go get that next shiny object, but not until everything is running smoothly. So you're not abandoning something to go to the next thing. You've
Exactly.
graduated. Yeah.
It's like you have it. I mean, I like to think about it as we've built this thing so that it's so freaking boring that I have time again,
Hmm.
right? And I'm just so bored, I can't sit still on my hands. I have to go do something else.
Yeah.
And there's little discussions you can get into there, but for the most part, when you've gotten there, what I did, I made the mistake of getting there, getting bored. Let's not do that anymore. Let's do this other thing. And huge mistake. Lost a ton of money, created a lot of stress in my life for doing that. When like in reality, I should still be flipping small, medium-sized lots in West Texas, Southern Colorado, Northern Arizona. Like there's no reason I shouldn't have another wing that's still doing that. And I don't because I jumped into doing the types of deals I do now, which again, everything happens for a reason and works out, but would have made a lot more money faster if I hadn't done that.
Mhm. Mhm. That's a great note to end on there, Clinton. Would love to have you back on the show because there's tons of knowledge that you've got. You could get into all kinds of stuff. What are your parting thoughts for the guests? Where can they find you online or listeners, let's call them?
Yeah, you can follow me on Twitter. You can follow me on Instagram. You can follow me on Facebook. You can, I don't know what other social medias there are. You can probably follow me there. The YouTube channel. At the end of the day, I do most of this just to do more deals or find people who want to invest with me. So if that's you, all my inboxes are open. Find me on a social platform. Bring me a deal. Always happy to talk about investing in land alongside us. That's all I got for you, Brandon.
Killer. The show is called Legends of Land, and it's named after people like you. So thanks for your time today, Frank. Good to see you, man.
Appreciate it, Brandon. Thanks a lot.
The Legends of Land Show.